This is where I want to get to risk parity and not about the current situation, but how you develop the theory. It comes out of this idea that everything happens over and over again. You want it, as I understand it, a way to invest that would enable you to sail through all the various ups and downs.
What happened in 1996 that got you to his introduction? What was that moment where you decided to take a bet on the ballast that is risk parity?
Well, in the early 90s, I had earned enough money that I was putting together a trust for my family. And I realized, I know that making money in the market is zero sum, and the asset allocation mix is the important thing. And I knew something about how markets work. And the problem of most markets is that you can't achieve balance. Like if you have a stock-bond mix, you know, you want to diversify, and you buy stocks, 50-50 of your money, 50% in stocks, 50% in bonds. The problem with that is you're dominated by equities because it has twice the volatility.
Right.
So I need more volatility in order to create a balance because I want to bet equally on two things. The thing about it also is that in the traditional way, then you have to buy more bonds. And as you're buying more bonds, you're buying a lower returning asset class. And as that lower returning asset class, you buy more, you dilute your return, and you're not getting much. So in order to have an equal amount on each one of those things, I have to have an equal amount of risk. And because if you look at risk return through time, those that have riskier asset, more volatile asset, tend to have a higher return and they have a higher risk. And that's structural because they have a longer duration and also because assets are leveraged themselves. Equities are leveraged. The average S&P 500 company has a debt-equity ratio of 1-to-1. It has embedded leverage. So the idea of taking a bond and changing its complexion of its return by borrowing cash and buying, let's say, 2 bonds for the 1 bond, is going to produce a return stream that gives me about the same amount of risk in both of those 2 assets. And it also raised the return because the return of cash is lower than the return of bonds over that period of time. And so that meant that I could create diversification. Because the most important thing is how do you create diversification without lowering your return? And so that was, I don't know in any 10-year period or in any period what's going to be good and not good. And I watched this. So I needed balance.
What does that tested model say, Ray Dalio, when your leveraged bond portfolio and your unleveraged equity portfolio correlate and stock prices go down and bond prices go down together? What is the shock analysis that you see within risk parity?
Well, as you'd imagine, what it would be is it'd be equal to if you own stocks. If you had 100% correlation between these 2 assets, in other words, now I've made it more leveraged so it has the same volatility, the same risk, and they were 100% correlated, then the mathematical answer is it will equal the volatility of stocks. So that's what it would equal. But the fact is, if it's not 100% correlated, we can get into what drives correlation. What it's going to mean
for that. That's before 3 p.m. Continue.
But what it means is that you're going to have, as a result, you're going to have diversification without lowering your returns. Comparable volatility. Now, if I apply that to different asset classes, so I can get diversification, then I can have a well-diversified. The most important thing is to have a well-diversified portfolio. Like I look today and I say, I would be terrified to own any other portfolio. And the reason I'd be terrified to own any other portfolio, what am I going to own? Am I going to own stocks? I'm going to be concentrated in stocks? Am I going to be concentrated in bonds? I don't want to be concentrated in bonds. I don't want to be concentrated in stocks.